the next concept that is pervasive throughout our country and in the media and questions from clients is, are we going to get inflation? So we wanted to show this in context. And this is a concern mainly because the US has seen fairly tame inflation of 2 to 3% over the past 25 years. And really the only time where we've seen inflation was in the 70s and early 80s. And right now there's a lot of concern because the last reading on CPI was above 4%, which is above our norm of 2 to 3%. But this needs to be taken in context because if you think about what took place from March to June of last year, we actually had some slight deflation as our economy shut down. So when you are coming off a low base, these are year over year figures. So the numbers are a little bit distorted as our economy reopens. Now, everyone, when they talk about inflation, the big thing that everyone talks about right now is, wow, we've seen a tremendous amount of money supply come into the system over the past year. And what you can see on that green line, the lime green line, is that money supply last year increased by over 25%. The last time this happened was during the Great Depression. And everyone thinks, oh, well, money supply increased so much, of course we're going to see inflation. Well, this is not necessarily true because if you delve deeper into, say, an economics 130 or 140 course, you've understood the concept of the velocity of money, where it doesn't necessarily matter about how much money is in the system, which the Fed can easily add or take away. It matters how quickly money is moving around the system. How quickly am I going to shop, and then that person at the shop is buying another good, and then Christine's buying something at the same shop, and money's really moving around the system quickly. And that's when you start to see inflation. And it's really only when you start to see what we show over to the left on the chart, where in 1975, where you saw the red line, which is the velocity of money, and the green line, which is the supply of money, when money movement started to pick up, the supply of money went down, and lo and behold, in 1975, you started to see inflation. Again, we got inflation a little bit under control, and then you saw the same thing happen in the early 80s, where again, you see the red line, money supply starts to pick up, velocity of money starts to pick up, supply comes down, inflation goes up. And so bringing it back to the right side of the chart, what you can see is, yes, money supply did pick up dramatically last year, but look at the red line. The red line is the velocity of money, which plummeted materially as well. So this is something that really needs to be looked at a little more seriously. Now, there's also two types of inflation, both of which we're experiencing right now. The two types are demand pull and cost push. So demand pull is essentially demand for goods has increased, so prices go up. The best example of this, in my opinion, is the iPhone. The iPhone, if everyone recalls when the iPhone came out, companies were giving it away for free. AT&T, Verizon, they were giving away the iPhone for free because no one was sure what the market demand for the product was. Well, as 10 plus years later, as we know what the demand for the iPhone is, now you can't buy a brand new iPhone for less than $1,000. So again, as demand goes up for a product, the company pushes up the price and because demand has increased. The next concept of inflation, the other type of inflation, is cost push, which essentially happens when there's supply disruptions, whether that be labor, capital, or materials. And when there's disruptions in labor, capital, or materials, input costs increase and companies push those input costs onto the consumer, which raises prices. So for demand pull inflation, what you can see on this chart, this is personal consumption in America. And what you can see is that during 2020, demand plummeted. from January 2020 to June, you can see that demand fell off a cliff. And from there, as the economy has started to reopen up, and people have come to grips of COVID, and a lot of more people are going out and about, you've seen demand has increased. But what you also see is that demand has not gotten back to previous highs that we saw before COVID. So yes, do we expect some demand pull inflation? Yes, but this is mainly short term to make up for the lost consumption during COVID-19. And another example of cost push inflation that's going on right now is in the semiconductor industry, where what people have to understand is that we live in a global economy. The supply chain is global in nature. US didn't shut down, just shut down. China shut down, Europe shut down, Japan shut down, the Middle East shut down. Every single economy shut down. And as every economy starts to reopen, and given our supply chain is now global in nature, which does have some benefits, the short-term cost of that is that there's going to be some short-term supply disruptions, which has hurt the semiconductor industry, and you start to see chip prices go up, whether it be affecting production of phones or cars, but this is going on throughout many different industries. But mainly, we think this is transitory in nature. So maybe you think to yourself, well, it doesn't matter necessarily what you guys think. What does the market as a whole think? And the best way to see what the market as a whole thinks is to look at this concept of the spread between a treasury bond and its corresponding treasury inflation protected security, or TIPS. So what's the yield on the treasury bond versus the yield on the TIPS? And if you look at the spread between those two, you'll see what the market as a whole is forecasting what inflation will be. And this is a global market. The United States Treasury, the 10-year Treasury, is not just owned by US citizens, it's owned by countries and people across the globe. And it's a very liquid market, and it's very informationally efficient. So what you can see here is that the 10-year TIP spread is saying that the market as a whole thinks that inflation will be about 2.4% over the long term, which is in line with historic norms. Okay, so let's just say we're wrong and the entire globe is wrong with what's being priced in the TIPS market. So what do you do to protect against inflation? Well, what we've shown here is the annual returns and the annualized returns of the entire period of the last time we saw inflation in our country, which is, as I said earlier, in the 70s and early 80s. And what you can see here from the assets and asset classes that we own for clients, the place to be was to own equities, whether it be the S&P 500, which returned 7.7% per year. Small caps, as we want to lean on smaller companies, have returned 14.3% a year. Berkshire Hathaway, which we own for clients, returned 24.4% per year. REITs returned 9.3% per year. Now, the one thing that's different between then and now is that if you look at the yellow bar, is that the US Treasury bond, the 10-year bond at the time, averaged a 9.1% yield. Now that's vastly different than it is today, where the 10-year Treasury is yielding anywhere between right now about 1.5 to 1.6%. And if inflation is 2 to 3, you're actually getting a negative real return on owning Treasury bonds. So the best way to think about it is that if you want to protect yourself against inflation, is to continue to own businesses. Businesses, another word for businesses, the way that we talk about it here, is equities, right? Because at the end of the day, one person's inflation is another person's revenue.